Hey, what's going on YouTube? This is Blood Phantom 81. Thank you so much for checking into my channel. Today I'll be talking about dividend stocks. And these stocks in particular are large cap, blue chip companies. These are household name type companies. So these are the type of companies that you want to get into long term, especially if you have some kind of DRIP, which is dividend reinvestment program, especially like M1 Finance or something like that, so that you can reinvest those dividends and increase your yield on costs, increase your yield overall. And the more I research dividends and yields, the more I come to appreciate how powerful they can be when growing your account. And at some point, if you do want to just supplement your income or basically live off your dividends, if your account is big enough, then that's very possible. So that's a goal of mine. Just a small fraction of my overall net worth is allocated to dividends, but it's still something that I want to learn more about. So yeah, I've done some research on some companies that I would definitely recommend. So yeah, let's just jump right into the video. So stock number one is Lowe's. The other thing I will say, actually two things before we continue. Sorry about that. Number one, if you're interested in getting dividends year round, then this video is definitely for you, because I'll be talking about stocks that pay at different times of the year collectively. And so these stocks in particular pay quarterly, so that's every 3 months. So some stocks pay on the first or second or third of the month, and so that's how you get the year-round dividends. So that's the first thing I wanted to say. The second thing I wanted to say is that a lot of the analysis that I'll be doing today is purely technical. And so some people might have an issue with that. I don't really care. The reason for that is because if in fact there was something really bad happening to the company, it would be reflected in the technicals. So like, let's say if we go into recession in the overall US stock market, there's a few things that have to happen first. One of those things, which is very simple, is that price action has to break the 200-day moving average. And that's a fact. Every single recession we've had, that's happened. So until that happens, I won't necessarily be worried. But I'll definitely be using that logic when understanding these stocks. So whether you think fundamentals drive stock prices or sentiment drives stock prices, which is what I think, then whatever, like you can still agree that technicals are a way of understanding what's happening in the real world. Whether or not you think they're predictive or not is a different story. So yeah, now we can continue on to the video. So like I said, stock number one is Lowe's. And so this stock pays on the first month of the year. So Lowe's is currently around $100 a share. They currently paid 41 cents on their last quarterly dividend return. That puts them at around 2%, which is pretty solid. I would say 2% or more is probably a steal for large cap companies, especially because a lot of them have taken a hit recently. But anything below 2% and the plan isn't as solid, I guess you would say. Something like Nvidia pays around 1% a year, but you're obviously not buying Nvidia for the dividend yield. But 2% is kind of the way to go with these companies. So yeah. And Lowe's has been increasing their dividends for about 54 years now, which is pretty nuts. I think Lowe's will continue to be a heavy conglomerate, owner of a lot of hardware and construction companies as well. Yes, they have some competitors like Home Depot, but competition is good. We live in a capitalistic world. So yeah, let's go ahead and take a look at Lowe's. So Lowe's has not retested its 200-week moving average since 2012, which there was a lot of market volatility, especially after the 2008 recession. It's perfectly okay. The S&P 500 did the exact same thing. And so ever since then, we've been in a very consistent uptrend. Over the last, I want to say, month and a half, we've seen a pretty large bounce, especially this candlestick right here, which happened on the week of May 21st. I do expect that trend to continue, although I wouldn't be surprised if we see some consolidation first. This candlestick in particular does not look very promising. So if we do retest this breakout area, which is right here, around $95, and then we take off higher, that's definitely something I can see happening. But for the most part, I wouldn't try to get too picky on Lowe's, especially if you can buy fractional shares on something like M1 Finance. So yeah, Lowe's is definitely on the list of stocks I would buy. Actually, is there anything else I want to say? Yeah, that's pretty much it. Oh no, actually I do. So there's a lot of bullish divergence that we saw play out, and you'll see why I brought this up actually. So just pay attention to this. So bullish divergence is when RSI makes higher highs and higher lows, but price action makes lower lows and lower highs. So after this resolved, we saw a really nice bounce, and you'll see why I brought that up. All right, so moving on. Another stock that pays on the first month of the year is AT&T. So this is by far the trickiest and perhaps most complicated recommendation that I'm going to give today, but I'll go ahead and explain why I think so. But I'm still putting this on this list. So AT&T is around $32 per share. On their last quarterly dividend yield, they paid around 50 cents per share, and they're currently at 6% of dividend yield every single year, which is pretty insane, especially for a large cap company listed in the S&P 500. So that's something to keep in mind. And they've been increasing their dividend yield for about 32 years now, despite a lot of the recent consolidation and correction in price. So yeah, let's go ahead and take a look at AT&T. So it's very clear from a long-term perspective that there's a lot of turbulence. However, I mean, that's definitely the first thing you notice. But if you really zoom out for a second, you'll see that the only two really nasty corrections were here in the dot-com recession and here in the 2008 recession. So ever since then, we've been in what I would consider an uptrend, although in the last year and a half or so, which started here in July, around July 2016, we've seen nothing but consolidation, and this recent candlestick right here looks really bad. So I could definitely see us making lower lows before continuing higher, but I don't see this trend continuing forever. And if your plan is to make AT&T a small part of your portfolio and continue to invest in it, that's one that I would probably go with. But I would first like to see some bottoming action before I do that. So this is not indicative of a bottom. That's pretty much all I'm going to say. But it's enough for me to keep this on my watch list and probably invest in little by little. So yeah. The next stock I want to talk about is Johnson & Johnson. So this stock pays on the second month of the year. They're around $32 a share. And Johnson & Johnson, as we know, is not only a household name, makes household products, but they're also invested in a lot of healthcare sectors and just in general about more than one sector. So that's one of the things I like about Johnson & Johnson. Healthcare right now is showing a lot of strength, as we can see with, I think it's called XLV, which is the ticker symbol for the S&P sector of healthcare. But anyway, so I do like how diverse Johnson & Johnson is. It's probably top 3 out of this list in terms of my favorite stock. But yeah, moving on. So they currently paid 99 cents in their last quarter, which puts them at around 3% of dividend yield per year, which is definitely very, very solid, especially for this type of investment plan. And they've been increasing their dividend yield for 54 years in a row. So let's go ahead and take a look at Johnson & Johnson. So Johnson & Johnson, as have a lot of consumer staple stocks, have seen a lot of consolidation over the last, I want to say 5 months now. The only difference between this stock and a lot of consumer staples and the S&P 500, for example, is that the S&P 500 has mostly, I guess, not really filled this dip, but it's been recovering a lot easier than a lot of the consumer staple stocks. But these continue to take a hit. So what I'm watching out for is this overhead resistance, which I think we're pretty close to breaking. We take a look at a long-term chart. Price action hardly ever tests this 200-week moving average. In fact, the only time we did was here in 2015, which I would consider somewhat of a flash crash. So yeah, take that with a grain of salt. But yeah, so we're hovering above it. I think we're going to take off pretty soon, to be honest. Not much really more to add, except it's not often that we see this type of consolidation. So we did see one right here. This is pretty standard. This resistance line acted as resistance for about a year, and then we broke above it, we retested it, and then we broke out above it. The other time we saw a really nasty resistance area was here, which was around the summer of 2016. And so now we're seeing something similar. So the one thing I want to note is that over the last 3 weeks, this looks indicative of bottoming action. So pretty nice bull hammer, which had some pretty nice follow through afterwards, and we're currently seeing a retracement of those gains. If we zoom in a little bit to the hourly chart, and we put some fib targets, I'd say we're not even at the 0.5. Yeah, so the 0.5 would be right here. If this is in fact an ABC correction, I would expect a 1-to-1 relationship between A and C, which would put us at around 121, which is pretty standard for a new impulsive wave. So again, this looks completely normal, and I would probably anticipate a bounce. So I wouldn't necessarily wait for this breakout. I'd probably get into it right now, which I actually am already investing in Johnson & Johnson. So spoiler alert at that. Yeah, so the next stock that pays on the second month of the year is 3M. And so this is probably my second favorite stock in this list. 3M is currently at around $200 a share. Their last quarterly dividend was $1.36, which puts them at around 2.66% dividend yield. A big reason why this yield is so high is because of how much dip it's seen recently. So let's go ahead and take a look at 3M. So 3M, a lot to say. I will say this. Again, first thing is that we haven't retested this 200-week moving average in a really long time, which was here around 2011, which is when a lot of the stock market saw some choppiness, so that's perfectly okay. We got pretty close to it here in late 2015, I would say. But ever since, including the 2008 recession, we've only really seen 4 heavy periods of consolidation. So 1, 2, 3, 4, and we're currently seeing 1 right now. I did mention how nasty this dip was, and so from the peak to the trough, we've dipped around 26%. However, there's still a lot of room to grow. So to get back to 52-week highs, there's still 26% left to go. This does look indicative of bottoming action. So if we zoom in a little bit, here we go. So again, this looks like a wave 1, wave 2, which has a deep retracement. Wave 1 again is as part of the larger 3 wave, and we're currently seeing some short-term consolidation. So if this is in fact ABC, I would expect a 1-to-1 relationship between C and A, which would put us around here. I want to say I would even see something as low as 200. But I'm currently buying 3M, and yeah, there's not much more to add. Although I will say this. This is something that I've been watching out for. Yeah. So when we do break above it, which is currently acting as resistance, when we do break above it, I would expect a pretty heavy breakout. On the daily chart, RSI got to around, I want to say 26 at its low, around 24 actually. So 24.9 around here. If you guys bought some shares here, great job. I think I managed to get a few fractional shares of this. But yeah, this does look like bottoming action. Everything's set to go. So yeah, this is a stock I'm pretty excited about. The next stock that pays on the third month of the year is Walmart. So Walmart sits at around $84 a share. Their last quarterly dividend yield was 52 cents, which puts them at around 2.5%. Again, very, very solid. And they've been increasing their dividend yield for 43 years in a row now. So there's a lot of speculation about why Walmart's taking a hit right now. Is it because large retailers such as Amazon are completely taking over the retail space, especially the online marketplace, which is constantly growing every single day? That's entirely possible, although not something I would put too much weight in. As a matter of fact, in my opinion, Walmart is still holding their stake in the online marketplace, and they continue to be a huge conglomerate, owning a lot of smaller retail companies, which allows them to get the best price possible on their products. I still think they're going to be a big bully for many years to come. So yeah, let's go ahead and take a look at Walmart. And in my opinion, it's just as simple as like Walmart just so happens to not be getting that much money into them right now. Not so much that sentiment is shifting, but more so that money is going into tech sectors, semiconductors, not so much big retailers right now. So it is what it is. But yeah, so going back to Walmart, the one thing I will note is this right here. So you guys saw me bring this up with, I want to say Lowe's. Yeah, I think it was Lowe's actually. So yeah, you guys saw me bring this up. This was bearish divergence, and this is bullish divergence. I'm sorry, this whole thing together is bullish divergence. So price action is making lower lows and lower highs, but RSI is making higher highs and higher lows. So this is something that I would definitely watch out for. Once we do break above this resistance trend line, I would expect a pretty heavy breakout. The interesting thing with Walmart is it's probably the most choppy, or one of the most choppy out of the ones that I'm naming today. Just because like of the wild swings, like, you know, large retailers usually don't see run-ups this big. So this was, you know, 93% increase since when did this start? Since the end of 2015. So in a little over a year, it nearly doubled in price. So like, that's why it doesn't scare me that we're consolidating right now, is because that was such a large increase. If we take a look at what's been happening over the past, you know, decade almost, is this multi-year base. So this trend line has been acting as resistance for close to 10 years now. We finally broke above it with gusto. We dropped and we retested it, and now we're taking off again. And this was a very sharp increase. So it's only normal that we're seeing this right now. And once this concludes, once we break above this resistance line, I think Walmart is ready to take off again. So that's something to keep in mind. With a lot of markets, the longer you go sideways or just stay in a choppy range, the longer you can expect to break out. And that's something that a lot of market wizards talk about and preach. In fact, if you read the book The Market Wizards, which is an interview of a lot of people that would be considered market wizards in our decade, such as Ed Seykota and other big names like that, you'll see that they constantly say to the longer a market goes sideways. Sorry, I don't know why I'm tripping up over my words. But the longer a market goes sideways, the longer the move you can expect to go up. And in fact, the best trade is to not trade at all. So if you see these tightening ranges, sit tight if they're going to resolve. If it's usually a big player in the S&P 500 or NASDAQ, usually it's going to resolve to the upside. So yeah, this is something that I'm watching out for. The last stock I want to talk about is Procter & Gamble. So this was my second favorite stock. This was my third favorite stock. And this is my first favorite stock. This is my favorite stock. So Procter & Gamble pays on the third month of the year. They're currently sitting at around $76 a share. Their last quarterly dividend was 72 cents, which puts them at 3.7% dividend yield, which is among the highest here. They've been increasing their dividend yield for 60 years now. So let's go ahead and take a look at Procter & Gamble. So one thing to note is that compared to the other ones, Procter & Gamble has broken below its 200-week moving average, which is this line right here. Does that scare me though? No. So every time RSI gets sub 30 on Procter & Gamble, we see a multi-year rally. The last time it happened was here in the summer of 2015, and we rallied from that period all the way to the start of, well, to the end of 2017, I would say. But okay, so that was that was over a 2-year rally right there. The time it happened before that here was in the recession of 2008, which was the bottom, which was in 2009. After that, we saw a, I want to say 6-year rally, just 6 years of straight melt up. So the question is, do I expect the same thing going forward? I don't know. That's up in the air for sure. But the one thing I will note is that we have broken out of this resistance trend. It acted as resistance for 2 candlesticks in a row, and then we saw a really nice breakout. Currently seeing some consolidation. It's not a very nice looking candlestick, so if we do retrace to around 75 flat, then I'd be okay with that as well. But this does look like bottoming action, as do a lot of these stocks, and we've been trading on this oversold RSI range for a pretty long time. So yeah, that's one thing I would note. So yeah, that about does it for this video, guys. Thank you so much for checking into my channel. I hope you learned something, and if you did, definitely go ahead and like and subscribe and all that stuff. Let me know in the comments if you guys are trading these stocks or if you have any questions or anything like that. With all that out of the way, hope you have a great day and good luck trading.